it is sort of this reality check where generative AI promised to change everything, give us better productivity, medical breakthroughs, environmental sustainability, personalized learning. But instead, what we've largely got so far is deep fakes, disinformation, spam, plagiarism. And companies are having to balance those risks with those longer term benefits. I don't think that anyone doubts this is the platform change that will eventually change everything. But to your point, Dan, they're starting to ask, where is the money?
Welcome to OK Computer. I am Dan Nathan, joined by Deirdre Bosa. She is the host of CNBC's Tech Check. Debo.
Hi, great to be back.
All right, we have a great show for you today. After Deirdre and I discuss all things AI, there is a large deal brewing, possibly with Google taking a look at Wiz. We're going to dig into that and kind of talk about the winners and the losers. We're going to talk a little bit about just the AI frenzy that's just, I don't know, turned into a little bit of a mania in both the public and private markets. Maybe it's gotten a little too hot in what's been a very hot summer. And then we'll talk a little bit about some of the largest tech names into Q2 earnings, which is going to get started in earnest with Netflix later this week. And then we get into, over the next 2 weeks or so, the Mag 7, if you will. Debo, let's talk about this. You were on CNBC's Fast Money last night and reporting throughout the day on CNBC about this proposed deal. I don't know if it's going to happen or not. Google's looking at Wiz. This is an Israeli AI firm valuing the company at $23 billion. It just started out, 4 years ago or so? They raised $1 billion in May at a $12 billion valuation. Talk to me. What's going on here?
Well, the first thing to know is that Wiz is an absolute darling. It has sort of the who's of venture capital backing it, from Index Ventures to Sequoia Capital to Andreessen Horowitz. You mentioned that $23 billion price tag that Google may be willing to pay for it. That is nearly double what it was last valued at just a few months ago. I sat down, I had lunch actually with the CEO and co-founder Asaf Rappaport a few months ago, just on the heels of that $1 billion raise. And, you know, he's such a smart guy and he's so confident. And we kind of more talked about whether he would be looking at an IPO. And he said, yeah, someday. He did not seem in any rush to do that or in any rush to sell. Part of the reason is because they have been so successful. You mentioned that they're 4 years old. I mean, just barely 4 years old, and what they've been able to accomplish is amazing. We showed this chart a lot on TV yesterday, but it's the cloud security market. And Wiz is now the third largest player, just behind Palo Alto and CrowdStrike, which are established cybersecurity plays. And it's just amazing that Wiz was able to get to that point so quickly. $350 million in ARR, annual recurring revenue. It's hard to tell you what a feat that is. So just such darlings. And I don't think that they would be willing to sell themselves easily. But a $23 billion price tag certainly helps. There's a price for everyone.
Well, it's fascinating. Go back to right before the Facebook IPO when they paid $1 billion for Instagram and people thought they were crazy. It was pre-revenue. Yep. And you tell me, what is that worth within, Meta right now? It's probably worth, I don't know, maybe $500 billion. I mean, for all you know, who knows, right? And so there's plenty of stories, Evan Spiegel, had a $4 billion acquisition. This is before, I think Mark Zuckerberg would have paid that before their IPO. And look at the enterprise value there. It has not been. Spiegel might have been better off, taking that $4 billion and moving on to the next thing, 10 years ago. So who knows? So just put some context around this, D. If you think about, they're targeting what? 1 billion in ARR, maybe by the end of this year or so. So that's up from 350 million. But, there's been plenty of kind of software and analytics names that kind of, once they reach that $1 billion number, you're going to see a pretty big deceleration in the growth there. So just thoughts on that, because again, within Google, it really is a cross-platform reselling strategy that would make sense for them to pay that sort of number.
Great point. So we talked about the Wiz of it all. Let's talk about the Google of it all and why they would be willing to pay so much. But just quickly before we go there, you talked about the cases where, acquisitions were steal, and those companies now within the mega cap are worth so much more. But for Google, this would be their biggest acquisition ever. Second in line is Motorola Mobility at $12.5 billion. That was not successful. They ended up selling it I think a year or a few years later at a loss. So your point, and like we don't know, but obviously, why would Google be prepared to do this? Because they need to boost their cloud offerings, right? They are a distant number three to Amazon's AWS and Microsoft's Azure. And I think they're trying to find their niche in security. They acquired Mandiant for more than $5 billion a few years ago. Wiz would help sort of bolster that case that they are really good on the cybersecurity front at a time when every CEO, CIO, CFO is worried about the cyber attacks to come.
Well, here was a good point made by Matt Hedberg at RBC Capital Markets, a software analyst over there. And I think he's really good at what he does. And this was in a note yesterday. We continue to believe that independent multi-cloud platform cyber vendors are well positioned as a hybrid multi-cloud enterprise environment become more complex and will require cloud agnostic cyber solutions. I think this is the really interesting part, though. In the same regard, we believe that independent cyber vendors could potentially benefit from Wiz being part of Google and not an independent vendor due to integration risk being part of the larger organization, potential talent departures, et cetera. More broadly, we believe the potential deal highlights the continued momentum in software M&A activity, which could act as a positive catalyst for the group. So I think that's interesting. So they're saying within Google, which is making the same point that you are making, that they have to beef up their offerings, right, to better compute, to get people or organizations to come to them. You need greater offerings. That makes total sense to me. And then the timing of this, mid-year, regulatory has been really hard for big deals. So talk to me a little bit about that, because even if they were to announce a deal, it wouldn't be approved. It would be tons of reviews. The EU would be looking at it, would go on and on, probably for at least a year or so.
That's the key question. And a couple of deals that got scrapped are still top of mind for big tech. You had Adobe and Figma, which resulted in $1 billion breakup fee, kind of a disaster for Adobe. And then you have Amazon and iRobot, and clearly these are the toughest regulators. They're cracking down on big tech M&A in a way that we haven't seen in so long. So this was interesting. I mean, obviously, Google believes it's worth it. They believe that Wiz is so important that they could take on the regulators. Another way of thinking of this is that maybe we'll have different regulators by the end of the year. These deals take time. 12 to 18 months is usually the time frame they put on them. If you have another Trump administration, is he going to put in regulators that are friendlier or at least less hostile to two different things here, though: big tech and M&A activity? And I think those are very separate, because we know that the former President Trump liked to sort of beat up on big tech. A lot of the investigations we have now, by the way, were launched during the last Trump administration. But could he be friendlier towards M&A in sort of this less regulatory stance that he has? I think that's an open question. There was a lot of optimism yesterday among market participants and analysts saying that, if you get another Trump administration, this deal is more likely to go forward. But then we got the announcement of JD Vance as running mate. And what I've been doing all yesterday and this morning, and for a while since his name began circulating, what is his actual stance towards tech? He hates big tech even more than President Trump, arguably. He has railed against Google, calling it the most important election integrity issue. And he's even praised Lena Khan, by the way, at the FTC. So I'm not sure that is super clear. And I think that the regulatory hurdles will be large either way. Not to say it can't get through. You saw Microsoft and Activision Blizzard, so it's possible.
Yeah, and again, a lot of these kind of West Coast, and it seems like the investor class, for the most part, are really backing Trump. They put together this large pack, and it seems like, from Elon Musk, maybe, contributing, tens of millions of dollars, but there's no shortage. And, we see where this is coming from, or why it's coming from, because the view has been that the Biden administration has been very hostile towards big tech. And you make a great point that a lot of this was started under the former administration. So let's see how that goes. I just want to put some context, though, on some publicly traded companies. You just mentioned CrowdStrike. CrowdStrike is a company that's expected to do $4 billion in revenue this year. It's got a 78% gross margin. It is profitable. on a GAAP basis, trades at about 93 times this year's earnings, 22 and a half times sales, and a $90 billion market cap. So just think about that. So when you bring up the point about whether this company Wiz should go public at some point in the future as they approach that billion-dollar revenue mark, I mean, there could be, a much higher number on their own in the future. And then the last one I just kind of want to look at, because this was a darling of the last IPO cycle. Look at Snowflake. Okay, this is a company that had a much larger than the $46 billion market cap that it has right now. That would be about 2 times what this proposed deal is talking about. And, this is a company that's barely profitable on a GAAP basis, expected to do $3.5 billion in revenue this year, growing 25% year over year with 72% gross margins. So big disparity. And again, Snowflake, it's a data analytics company. It's very different than, what, let's say, a CrowdStrike does and what a Wiz does. But I just wanted to put some context around what's going on in the public markets right now.
It is a great point. Snowflake, along with some of the other sort of data analytics firms, the Datadog, Databricks in the private markets, a year ago, we were talking about them being AI beneficiaries, right? In a world of AI where data is gold, they're the ones that are going to collect it, curate, crunch it for you. And Snowflake at least has just been kind of a dud. Datadog as well. We don't know Databricks as much because it's private, but Snowflake, I think the CEO change hurt it. And the cybersecurity breaches, that to me is just so brutal for a company that is its thesis is protecting your data.
Yeah. No question. And that AT&T data breach is just this month's reminder of just how all of this stuff is just under attack. I want to read a quote and when we take the temperature of the AI craze, both again in public and private markets. This is from Jim Cavello from Goldman Sachs. He's the head of global equity research. And I'm getting this from the transcript, which is a service that I think is very important as we head into the next couple of weeks, because as well as anybody, a lot of these massive companies that you follow, they're all going to be reporting in the same day or two, and just to keep track of them is very hard. But this comment was really interesting to me. This was in a report, I think last week. Roger McNamee was quoting this on CNBC, and I just really stuck out to me. The quote from Jim Cavello was, AI has shown the most promise in making existing processes like coding more efficient, although estimates of even these efficiency improvements have declined, and most utilizing the technology to solve tasks in much higher than existing methods. For example, we found that AI can update historical data in a company model more quickly than doing so manually, but at 6 times the cost. Okay, so this is the sort of ROI that a lot of, let's say, companies are going to start to focus on after some of these initial investments. Speak to that a little bit, because I know you talk to a lot of folks at companies, a lot of investors, and everyone's going to be scratching their heads at some point if you can't show us the money.
Everyone is starting to scratch their heads and asking, where is the money? This is actually the topic of our Tech Check weekly deep dive this week, so watch out for that. We publish it on Friday. It's not just Goldman Sachs questioning the ROI. It's Sequoia Capital, one of the most prestigious VCs here in Silicon Valley. They're talking about this gap and saying that the ROI is not justifying all of the CapEx costs as well. And then you've also got Barclays out with a note. So it is sort of this reality check where generative AI promised to change everything, give us better productivity, medical breakthroughs, environmental sustainability, personalized learning. But instead, what we've largely got so far is deep fakes, disinformation, spam, plagiarism, and companies are having to balance those risks with those longer term benefits. I don't think that anyone doubts this is the platform change that will eventually change everything. But to your point, Dan, they're starting to ask, where is the money? We've had, what is it, $1 trillion in CapEx? And even you look at a Microsoft, and I can't remember what the number was of how much generative AI contributed to its cloud revenue last quarter, but it was less than 10%, right? And I don't know that it's going to be a huge amount this time. And, there's going to be winners and losers, clearly, but I think that we'll start to see the losers shake out in the next few years.
Before we kind of just talk a little bit about like what we're going to see from some of these large hyperscalers, because again, I think you put this, at front of mind very clearly, is that that's the one area, if you think of Google Cloud, if you think of Azure, if you think of AWS, where they've been kind of, investing tens of billions of dollars, and they better start to see, some sort of revenue contribution that's greater, to your point, than 10% of the total cloud revenue, or the spend is going to be one of those things where you're going to have to say they're going to have to dial it back. And what are the implications of doing that as it relates to, let's say, Taiwan Semi, NVIDIA, and a host of others? So again, that's going to be really interesting during earnings season. But I just want to make one other point here. If Sequoia, which has been at the forefront or early on every major tech trend for maybe the last 40 years, is starting to kind of say, hey, we should probably take our foot off the pedal a little bit. This is really interesting to me. Last quarter saw a whopping, this is from Crunchbase, 24 billion invested in AI startups. Okay, so when you think about just that, it looks like we're hitting a fever pitch. And then when you have, just throw that on top of what might be a $23 billion Wiz acquisition, things are happening at like massive speeds here. And a lot of folks are going to go back to the mid to late 90s. And this was a conversation that David Faber had late last week with Roger McNamee. Again, I'm citing that, where, David pushed back a little bit and saying, okay, there was a lot of capital thrown at the internet at that period. And there was lots of huge assumptions made about how disruptive this technology was going to be. But we've never seen anything to this scale. And while there was no shortage of bankruptcies, right, during the downturn in the early 2000s, companies like Google and Amazon, which were some of the ones that took the most funding, probably from the likes of Sequoia, it took them a long time to realize the promise of those investments, in the late 90s.
Right. But we're still early. That underscores that point, which everyone here will tell you. And so much of the revenue that we're seeing so far just comes from one company, OpenAI. So, and it's early though, right? Because even in the internet era, you saw early winners become losers eventually. So we'll start to see this shake out. But I thought the question that Sequoia asked was a really good one. Brings it to consumers. And they ask, outside of ChatGPT, how many AI products are consumers really using today? I can't name one.
Yeah.
I think that the iPhone will be interesting. But again, is that truly, like a standalone product, or are those more generative AI enhancements?
Well, and that's a great point about, OpenAI is, as far as consumers are concerned. When you think about Apple and the deal that they just did, and really focused on Apple Intelligence, and you look at the way the stock rallied, it's not rallying, I think, on what might be the adoption from a consumer standpoint of this technology, because they're going to take a while to roll out all of those features. You know what I mean? It's not just going to come on your new iPhone 16 Pro when it ships in late October or early November. So the assumption that there's going to be hundreds of millions of iPhones upgraded because of this, I just don't think that's the case. And when you think of the price appreciation this stock has gained in just a matter of weeks since WWDC, but also since April, it's pretty astounding. Now this is a $3.5 trillion market cap company that for a little bit lost that kind of, largest market cap company to Microsoft, but it gained it back. And the last thing I just want to say, Dee, and I want to get your take on this, is like, what is your sense from public market investors? Last July, we could have had the same podcast where a lot of excitement about generative AI had reached a fever pitch, right? And from late July until late October, the S&P sold off about 11%, the NASDAQ a bit more, and some of the biggest names had sold off 15 to 20% or so. And I'm wondering if we start to have that same sort of enthusiasm wane as we start to get Q3 guidance from some of these big companies.
That is such a great question, right? Does the skepticism from Goldman Sachs, from Sequoia Capital, Barclays, does that sort of impact the public market perception of the mega caps? NVIDIA, probably not, because there's real numbers, sort of the exception behind that. But for the software names, certainly this is going to be such a critical earnings season. Whereas if you don't see sort of big bumps up from generative AI from the likes of Microsoft or ServiceNow, the whole space is going to be in even more trouble. The other thing that's been interesting, and I know you've been watching this closely, Dan, is sort of the market rotation, right? You see some of these small caps start to catch a bid now, and maybe that's related to the perception of where interest rates are going to go. But does that mean that you see a big unwind in the semis, which have been the winners, aside from NVIDIA, on sort of more hopes than real numbers. So that will be something interesting to look at. But in our weekly piece, too, we look at this idea. I love this chart from Gardner. I always go back to it. It's the technology hype cycle. And you have sort of like irrational exuberance at one point, and then you get into the trough of disillusionment. And that is when you start to get asked these questions. And maybe you'll see some softness in the AI winners in the public markets. After that, the slope is steadier, right? You have the hype cycle, which is sort of up and to the right. The trough of disillusionment goes all the way down. And then the slope where you actually see the technology start to be used in real application, real use cases, is a lot steadier, not straight up and to the right, but just a more of a slope upwards. So maybe that's where we're headed.
Yeah, and that goes back to the point I think Cavello from Goldman Sachs was making is like right now at the certain scale that enterprises are using this technology, it's just too expensive. But then you think about, once the thing, we get into this inference phase and a lot of different companies are using it and they can justify the spend across, a larger platform, then to me, that's what the next phase of that trade is going to be like. What industries are using this to cut costs and being more efficient? But that's going to take a little bit. And then the other point I wanted to make is that you just talked about this rotation that we're seeing. So, NVIDIA and Microsoft and some of these other names have kind of stalled out as the S&P has gotten back to all-time highs. And, we've seen small caps, the Russell 2000, go up in a straight line 10% over the last week or so. But here's the thing about a rotation. $3 trillion are in the Russell 2000. That is the market cap. That is less than Microsoft and clearly less than Apple. So you have to see a broader rotation. We're seeing it in financials. You're seeing it in some more cyclical names, maybe as the expectation for rate cuts is building into September. But again, this is one of those things, and not too different than last summer into the fall, is that you can have rotations until a certain point. But sooner or later, if there's any fear that's put back in the market, maybe it's some macro event, maybe it's rate cuts get pushed out, maybe inflation picks back up, that sort of thing, you'll have correlations get much higher, right? And you'll see all sort of stocks in all different sectors sell off. And it will be led, to your point that you made earlier, by these mega cap names.
At the same time, and I think we talked about this theme, maybe it was last year when we saw sort of the wind come out of them a little bit. But when the macro is more uncertain, it's kind of, we called it Jay Powell versus AI, right? Even when the macro is not looking good, people will go to the mega caps because of their, great balance sheets, their moats. They're set to benefit if AI becomes big. And they're also set to benefit if it doesn't, right? They just touch so many different parts of our lives, which is why investors, speaking of, I was also interested in Kathy Wood's letter. She's kind of bought everything but the mega caps. And look at how that has turned out. So it's really been like the safest place to hide over the last few years too.
And she sold NVIDIA like a year and a half ago or something like that. She's definitely a bit questionable in my mind. I've said this on many occasions, I guess, other than Tesla, but maybe including it this year until a certain point. Her top holdings in the ARK fund look like the island of misfit tech toys. I mean, these are things that were like the hottest things in 2021, right? And now most of them are down 75% still. You know what I mean? When you think of them. All right, the last thing I just want to hit, and this is something that my good friend and your good friend Guy Adami has quoted a couple times. I think he said it on Fast Money on Monday, but he's also said it on our pods, is that you look at the appreciation in the S&P 500 from a multiple perspective, and obviously from an earnings perspective too. It is this kind of Mag 7 or these top 10 names or so. And it's been multiple expansion. Most of the gains have been, from multiple expansion. I'm just looking at Microsoft. It's trading about 38 times this year and 34 times next. Apple, is trading at 35 times this year and down a couple turns next. These are, valuation levels that these stocks have not seen really in 20 some years or so, when we were last really excited about a lot of this sort of stuff. So at some point, if you see growth decelerate, and you might, maybe not in Apple because growth expectations have been in the mid to high single digits for a while. So maybe that's one of the reasons why people are justifying spending this or at this valuation level now. But Microsoft may come in, NVIDIA might come in. And the last point I'll just make is that while NVIDIA doesn't report, I think, until the third week of August, 40% of the revenues come from Apple, Meta, Microsoft, and Google. And so we're going to get a good read on what their CapEx spend is in the next week or so.
I've been thinking a lot more about Microsoft recently because to me it feels like it could potentially be the most vulnerable. When you talk about valuations, I think it's at the highest or one of the highest of those Mag 7. And it was seen as the early winner in AI, and now it kind of seems like the mark. They paid over $10 billion dollars for an observer seat on OpenAI, while Apple was able to spend nothing. Google at least has its own model. Microsoft has been relying on OpenAI. We talked about this a few weeks ago as well, which is increasingly looking like a competitor in the enterprise space. And it feels now like Microsoft is the one trying to play catch up. Of course, they're going to develop their own model, especially with that inflection acqui-hire, essentially, when they hired Mustafa Suleyman to head up their AI efforts. And also this whole idea of the rise of smaller LLMs, right? Microsoft made a huge bet on OpenAI and a large language model like ChatGPT. And now you're seeing that it's the companies with the talent, the AI talent, and starting to just look at it again. And maybe those smaller models are more efficient, less costly. And where does that leave Microsoft? I think they seem vulnerable just because they have that really high valuation as well,
Yeah, no
and less
doubt.
to show for it potentially.
There was a great article in the information. We'll put that in the show notes, talking a lot about what you just mentioned here. Also, the last thing I'll just say is Dee mentioned her Tech Check Weekly that drops on Friday. We'll put a link in there for where you can get it Friday morning, because I really love that work. It really, you quote a lot of great people, you bring them into the conversation, and it's a really succinct, piece that is summarizing or really doing a deeper dive in some stuff that we all kind of have little soundbitey things. And so I appreciate that, Dee. I really appreciate you being here and going through all of this with us. Hopefully we'll see you again next week. But I know in the meantime, we'll see you on CNBC's Tech Check. I appreciate it.